In this session, let's look at another important function of the finance manager. How does he manage the dividends, and how does he manage the repurchase, buyback of the shares? What are these two things? What is the relationship between them, and in which cases one is better to the other? These are some of the aspects that we will be looking at in this chapter. So, the basic understanding in these two areas, again, both are both are related to the profits, based on the profit or net income generated by the company. Both are based on the net income. Company has generated some profit. Using that profit, should it give dividend or should it buy back some of the existing shares? So both of them have that kind of a linkage. Whatever the net income the company has generated, for what purpose it has to be used, to what all uses that the net income can be put to. So from those standpoint, we will be talking about these two concepts. So from a dividend standpoint, we get to some of these things like the company can give a dividend. Dividend is nothing but whatever the regular amount or whatever the amount that is really paid to the investors, to the shareholders. Whatever the company pays to the shareholders, the term that we use for it is dividend. As long as the person is holding the shares, not selling off and getting the excess amount, as long as the person is holding the shares, whatever the company is paying to that shareholder at different intervals of time, we are calling that to be the dividend. So that dividends, either they could be in a cash form or they could be in the form of stocks, is additional shares. In a typical some countries parlance, this is also called as bonus shares or bonus issue. There are so many names to it. So the typical term which we are going to use is stock dividend, which is nothing but the payment to the investor is not in the form of cash but in the form of stocks or new shares. So in case of cash dividend, again, what will happen, what when the company is paying some money out of its profits to the investor, what is going to happen? The size of the profit is actually coming down. Whatever is the worth of the company, right? Whatever is the scope of the company, value of the total company, if some amount is going out from the company, the value of the company is decreased by that much extent. The value of the assets of the company, because cash is also one asset, the value of the assets of the company are going down by that much extent. On any day the dividend is paid, it's like some money is moving out from the company to the pockets of investors. The day the movement happens, it will reduce the value of the company's assets, and the overall equity is also coming down, because otherwise that entire portion would have been retained. If the company doesn't pay any dividend, it goes as retained earnings. If it goes as retained earning, the size of the equity is going up. Now, if that some portion is paid as a dividend, the retained portion is coming down. So the size of the equity is also coming down for the company. So this kind of analytical approach is very much required for us in solving all the questions, right? So basically what goes up, what goes down is some of the things where we have to give more and more stress on in understanding these kind of concepts, right? Now, coming to the dividend, from a company standpoint, there are three types of dividend. Companies talk about a regular dividend, a special dividend, and a liquidating dividend. What are they? Regular dividend is something which is paid every year. And one thing before we discuss something more on this. The dividends are always declared as a percentage of face value, right? Sometimes a company says we are declaring 5,500 percentage as a dividend. It doesn't mean that 5,500 percentage of the share price is given as dividend, or it has nothing to do with that. The dividend always is given based on the face value of the share. If the face value of the share is, let's say, 1 rupee, there are some shares whose face values are 1 rupees. There are some shares whose face values are 10 rupees. Like that, you will find different shares, they have different amounts of face value. So, when we talk about dividend, we have to look at, they'll simply say we are giving this time 5,500% in the form of dividend, or we are declaring a 40% dividend. It's not 40% of the profits given as dividend. That's a very common wrong notion for the people. It's not 40% of the dividend, profit given as dividend. When they say we are giving 40% as dividend, it doesn't mean 40% of the profits are given as dividend. It means 40% of the face value is given as dividend. So if the face value is 10, then 4 rupees per share is what is given as a dividend. So even if the company is saying we are giving 5,500 percentage as dividend for a share value, for a face value of 1 rupee, it means only 55 rupees per share is what is going as a dividend. Right? So here comes the three categories of dividend: regular dividend, special dividend, and a liquidating. Regular is something which the company declares more or less every year. And this regular dividend, the company doesn't want to increase drastically or decrease drastically also. Because generally we see the regular dividend will be more or less consistent every year. Right? Probably if they are declaring 200% every year, they'll try to maintain it around that same 200%. Slightly more, slightly less, but not drastically more or drastically lesser, because it's the first prima facie information which any investor will basically expect from the company. Okay, this company is going to give me some 20 rupees per every share, right? So it's a minimum expectation which the investor will set every year, just like we get interest into our bank accounts every year. Right, the moment we have a fixed or savings deposit, we expect some basic amount to come into our account every quarter in the form of interest. So the regular dividend also is typically observed from that standpoint. Okay, more or less the company will give me 20 rupees a share every year in the form of dividend. So that's where companies don't want to tinker around with it very heavily. Because very high means, if let's say they have suddenly increased it to 30 or 40, it means from the next year the expectations of the investors will even more go up. And if the company is not able to generate that much of heavy profit in the next year, so the expectations will go down drastically, which will have an impact on the performance of the share in the market. Right? So they don't want to give very high or very low as a part of the regular dividend. They try to maintain consistency in the regular dividend process. So it's like investor is more or less confident that the company is going to give something like this. So if that regular dividend is not given, the investor will start thinking negative about the performance of the company, because every year they were able to give this much. Why not they give it this year also? So is there something that has happened? Even if a person doesn't have too much of a financial statement knowledge and all those stuff also, he'll expect that amount to be given every year. And so that's what goes as a regular dividend. Right? And if they have given higher regular dividend, it means that every year they may have to meet those expectations. Otherwise, it looks like last year when they have given, why not they give it this year? So that's where they try to maintain the consistency in the regular dividend process. When it comes to special dividend, these are some of the cases marking some special occasions of the company, wherein they'll say this year we'll give another 500% extra. Probably they'll link it to some event, right? Probably let's say the same 5,500 every year. They cannot give that 5,500% dividend. And this was the case of one of the companies itself. The Hero Motorcorp has actually given it in 2010. And the number is significantly higher. Every year they were giving only 35%, 40%, or probably 100%, 200% in the form of dividend. But suddenly it rose to 5,500% of the face value in one single year. That was marking their silver jubilee year or something like that. So Infosys sometimes it has given when it has reached $1 billion company mark. So in some of the years, just as a gratitude to the existing investors, what they will not club it as regular dividend, because then again next year the expectations will go up. They'll package it as a separate thing, special dividend, and say because of this we are giving you something more, so that the expectations will not be there in the next year. So we are declaring a special dividend this year, some such kind of a statement will come. So those things, they are there. So that's also some kind of cash which the investor is receiving. The moment investor receives the cash, all these things will happen. The value of the company will go down by that much extent, even the market value of the equity, and then the share price also will go down by that much extent on that spot, because it's like investor has already received some benefit. So share price has to go down by that much extent. If he has already received some 20 rupees, right? If he sells, let's say he can sell it at 2,000. Out of that 2,000, he has already received 20 in the form of dividend. So basically now all he is supposed to receive is only 1980. So the share price goes down to that extent from a reality standpoint also. So the market value of the equity will go down. The company's assets value will go down, because there is a cash outflow from the company, any dividend. And the third is slightly a negative form. Liquidating dividends generally are applicable when the company is winding up. When the company is winding up, whatever the final thing that is left after paying to the lenders and everything, whatever the final thing that is left, that is what goes to the equity investors. So the liquidating dividend is basically that dividend, that portion of their investment that goes to the equity investors when the company is winding up. So though the first and second are looked more in the form of positive, the liquidating is a kind of a negative aspect of the company, because that comes up only when the company is winding up or closing some portion of the business, selling off some portion of the business, and that amount it wants to distribute to the investors. Those kind of cases we bring in the liquidating dividend. And when we are talking about the stock dividend, the issue is in the form of shares, so that no cash goes out of the company. Just try to look at this scenario. If I am giving an additional share to you, right, no cash is going out from the company, but the number of shares are going up. Number of shares that are available in the market are going up, because I am giving new shares. I am not adjusting the existing shares, right? A bonus issue or a stock dividend is the process of issuing new shares. So from 100, the number of shares will go to 200 or 150 or something. The price will come down by that extent, because the market value is not changing, right? The new shares are given for free without extra capital, which means the total market price should be distributed among all the shares. So the price of the share will typically come down, but the advantage is cash remains within the company. There is no cash shortfall within the company. So whenever the company wants to retain a large portion of cash, and it does not want to give in the form of cash, what it will very well do is it can resort to the stock dividend kind of a process. Now, whatever is the form of dividend, there are some other forms of reinvesting the dividend. In some cases, individual shareholders can opt for the dividend reinvestment plan, which means the difference between a stock dividend and a dividend reinvestment plan is in stock dividend, the company will make it as a mandatory thing for everyone. We'll give you additional share. Whereas in a dividend reinvestment plan, it is optional. If you want to take it in the form of cash, you take it. If you want to give that cash back to us and take additional shares, we'll give it to you. So dividend reinvestment plan is more at the discretion of the investor, whereas the stock dividend is more at the discretion of the company. Both of them are one and the same. But in the dividend reinvestment plan, at least the flexibility exists with the investor whether he wants to reinvest and reinvest for additional shares or continue with the taking the cash itself. Whereas in case of stock dividend, the company itself mandatorily issues a dividend. And one more thing we have to look at in the context of the stock dividend is stock split. Sometimes we say stock split. In some contexts, we also use reverse stock split. Now, we have to understand this aspect. Stock split has nothing to do with the performance of the company. Our stock split is purely a stock market activity. It is not a corporate activity. See, dividend, whether it is in the form of stock dividend or cash dividend, it's a part of the corporate activity. Some cash is really being paid either in the cash, something is paid from the company to the investor, either in the form of cash or in the form of additional shares. So these two are more based on the performance of the company. Whereas when I say stock split, split also increases the number of shares, but they are not additional shares. Split also increases the number of shares, but they are not additional shares. The existing share itself is broken into two pieces. So which means in case of a split, the face value will come down. A 10 rupee share, when it